Hello, fellow Rebel Capitals. Hope you're well. So we have big news with the GDP prediction from the Atlanta Fed. This algorithm is called GDPNow, and it's kind of a forecasting tool the Fed uses to determine in real time what they think this quarter's real GDP numbers are going to look like. So let's shoot over to the Atlanta Fed's website and check out this recent change they've made. And this not only surprised the markets, but it shocked me. You'll see why. But I think we need to really look beneath the hood and see what's going on with these numbers and why on earth did they change their indicator or their forecasting tool to such a dramatic degree just either today or yesterday. So let's go over to the website here, GDPNow, and you can see this huge change. They went from forecasting, what was it, just a couple days ago, or maybe even yesterday. No, I'm sorry. Yes, it was a couple days ago. They were at barely over 2%. So call it 2.1, 2.2%. And then it goes straight up to 3.8. And then today it goes up to 4.6. 4.6. This is great. Now keep in mind, this is real. This is not nominal. This is adjusted for inflation. So the Atlanta Fed is forecasting, and this is their real-time forecasting tool, 4.6. So we go from a -3, or revised -2, to a positive 4.6. Now, I know a lot of you that pay attention to this stuff are probably saying to yourself, oh, well, George, that makes sense because we had that huge drag on GDP in Q1 because everyone was front-running tariffs, and that increased the size of the deficit, which negatively impacts GDP. Right, but you're not thinking about the other components of it. So we're going to dive into that a little bit deeper here in just a moment. But let's read what they're saying and what their explanation is for this massive increase. So GDPNow model estimate for real GDP growth in the second quarter of 2025 is 4.6 on June 2nd, up from 3.8 May 30th. After this morning's release from the U.S. Census Bureau, an institution of supply management, the now CAS, of second quarter real personal consumption expenditures growth and real gross private domestic investment growth. Okay, so this is the part, that latter bit is what I'm going to focus on when we get into the nitty-gritty here, because that went from negative 1.4% to a positive 0.5%. So you can see where blue chip consensus is still right around 1%. And now let's go over, just so we're all on the same page here, let's go over what goes into this calculation. It's actually pretty straightforward. We've got four main components, and what I want to focus on is this business investment. So I wish I could zoom in here. Maybe try to zoom in. There we go. Cool. That makes it easier for you guys to see. So we have personal consumption expenditures, and this is goods can be, okay, so you guys know what that is. That's just basically what people are, it's retail. It's not just retail. It's just kind of all non-government spending is kind of aggregated and totaled. And then we've got the government spending, and then we've got net export. So this is just the trade deficit, right? So if the trade deficit is, let's actually go to that right now. If the trade deficit is, where was that? It's coming up here pretty soon. There we go. If the trade deficit is 140 billion, then you're going to deduct that from GDP, because what GDP is trying to figure out is the goods and services that were produced in the United States. So if you're calculating all of the consumption, including government, and aggregating that Well, you have to subtract the consumption that was due to the imports. And so but then you'd have to add the exports, right? So that's why it's the net difference there. In other words, the deficit or surplus. And we know in the United States, we're most likely always, well, not always, but it's very, very high probability it's going to be a deficit unless something dramatically changes like we saw in the late 1990s. Or if you watched my interview yesterday with my good friend Hugh Hendry, he's predicting that we could see a trade surplus in the very near future. You got to watch that interview. But it's not just a Neanderthal argument like most of them. Most of the arguments that you get for us running a trade surplus is just, the inverse of Trump derangement syndrome. It's Trump derangement syndrome, but instead of thinking that he's, let's say, the leader of Germany in the 1930s, you think that he's the second coming, the second coming of Christ or something like that. And it's just, so there's two ways Trump derangement syndrome can go. And usually the second coming is what leads us to, this argument, if you want to call it that we're going to have a trade surplus. But Hugh is, I think, has a much more nuanced view. Anyway, let's get back to what we're talking about here. So we go back to what makes up this GDP number. So this is what the Atlanta Fed forecasting tool is trying to predict in real time based on every single one of these data points every single one of the major data points that we get. But look at this one, business investment. So divided into two subcomponents, fixed investment and change in private inventories. So change in private inventory. So what happened last quarter's GDP numbers was we had a massive increase in private inventories. Well, that was a positive for GDP. That was a big positive. So, and then, what's interesting is how the GDP number is put together. So you have the personal consumption expenditures, and you would think, well, aren't you doubling up, or aren't you adding to the same numbers? One should be there, one shouldn't be there, right? What I mean by that is if you've got, let's just say, $5 of inventory, and you've got $5 spending to buy the inventory, well, aren't you doubling the number, right? Doesn't that lead to an inaccuracy? But what's neat about this GDP, and it's not perfect, but what's neat about the metric is that's all else being equal. That spending, that additional $5 of spending to buy the inventory is going to reduce the inventory level, and therefore it's going to net out, right? So, and that's important because last month or last quarter's GDP number, like I said, we had a big net drag because of the deficit, but we had a huge increase in inventories. Why? Well, you guys know it was front-running tariffs. So if we're front-running tariffs, if that process is leading to a big trade deficit, which is a negative, it's also leading to a huge expansion in inventories, which is a big positive. So now let's think about it. Let's go back to the Market Watch calendar, and we see that the prediction or the consensus expectations is for the trade deficit to go from 140 billion to 63. So what most people are thinking is like, oh my gosh, well, that means that this is going to add, let's just say 80 billion to this month's or this quarter's, I keep saying month, this quarter's GDP. And maybe that's what is going into, or at least a component of what is going into this Atlanta Fed's forecast, going from basically 2% straight up to 4.6. And I'm sure that has something to do with it, but we have to realize that if the deficit goes down by 80 billion, you could see inventories also go down by 80 billion. Because what is front running? What you're doing is, let's just say your normal inventory level is at a 5 on a scale of 1 to 10. So what you're doing by front running is you're taking your inventory levels up to a 10. Okay, well then what are you doing over the next few months? You're selling those inventories down to a 5, or you might even be selling them down to a 4 or a 3 because you want to wait this out. You know that Trump is got the taco trade, and it's, what is that? Trump always chickens out. So you're like, okay, Trump always chickens out, and right now there's a 10% tariff on the stuff I buy, and I'm at a 5 right now. So I'd rather roll the dice and go down to a 4 or maybe even a 3 in my level of inventory to try to just ride this out to see if maybe Trump reduces the tariff on the stuff I buy even further, and then that lowers my price, and then I'll go back up to the 5, which is kind of the sweet spot. That's my comfort zone. But my point here is drawing down the inventory from 10 down to a 5 because you're not buying any stuff because it's now a higher price, which would be reflected in the expectations for the deficit, right? That's why they're saying the deficit is going to go from 140 down to 60, because there's not going to be near as much buying, therefore filling the inventories. So my point here is, when you look at this FedNow estimate, this forecasting tool, I think you've got to consider the negative impact on what will likely happen to inventories, because I know it's talking about private domestic inventory growth, because I don't know how you're going to get inventory growth. This doesn't, unless I'm private investment. Okay, so they're saying that domestic investment growth, which a component of this growth is inventories, which I think are going to be dramatically negative, they're saying is going to be a positive 0.5. I just, maybe, I mean, they know their tool a lot better than I do. That's for sure. But I just don't see, you would have to have, and let's go back to the two components that make up business investment, because this is what they're talking about right here, going from negative 1.4 up to 0.5. And this is what I'm focusing on, is just one of the two subcomponents. So let's just assume that I'm right, and the change in private inventory goes down dramatically because the deficit goes down, which is a reflection of what these businesses are doing with their inventories. Let's say I'm right. Okay, well, in order to get a number, a positive number on the other subcomponent, which is fixed investment, you would have to have a massive increase, because that needs to outweigh the negative draw from the other subcomponent. So maybe, but I just, it seems like that's a very low probability, unless businesses just continue to buy more and more and more inventory, taking their inventory levels up to 15 when they're normally at a 5. But if that was the case, then we wouldn't see the deficit go from 140 down to 63. We'd see the deficit barely go down at all, which would be the negative draw on GDP, which would offset those inventory levels. Another thing I want to point out is, well, let's hold off. I was going to point out factory orders, guys, but let's actually, I want to get to that a little bit later on in the video. So let's keep going here. I want to go over, because remember, this is at 4.6. So I think it's important that we look at historical precedents for a 4.6 number, because it's, you know, what does this mean in the context of what has happened over the last 10 years, let's say? So here I've got quarter by quarter real GDP. Like we said last month, 0.2, I think that was revised up from 0.3. But go back here to 2015. Look at this, 2.5, 1.6. I'm going to try to find, this one looks, here's a 4.6 we had in 2017, Q4. Okay. And here's a 4.8 we had in 2019. But for these 5 years between 2015 and the end of 2019, we only had one quarter of GDP that was higher than 4.6, which is what the Atlanta Fed is forecasting right now. And we had one more that tied. So we only had 2 quarters in 5 years that was as high or higher than what the Atlanta Fed is predicting. Now we go over to the cerveza sickness, and you guys know what happened here. Of course, we had 6.4, we had a 7.4, but this was all stimmy money. This was all stimmies. Then after the stimmies start to kind of fizzle out, we have a 3.4, we have a 4.4, but if you exclude the stimmies and go all the way back to, the last 10 years, there have only been 2 quarters in the last 10 years where we have had GDP growth of 4.6 or higher. 2 quarters in the last 10 years, excluding the cerveza sickness, stimmies. So, is it possible that we have 4.6? Sure, absolutely it is. But think about what that would mean. That would mean that the economy is just on fire. The economy would be absolutely booming. And my goodness gracious, if you could sustain this over the entire year, that would be, Trump would almost be right when he says the economy is the greatest of all time. And I would ask all of you watching this video right now, does the economy feel like it's the greatest of all time? Does the economy feel like it's basically the best or very close to being the best it's been over the last 10 years? And actually, I'm curious because I'd like to go back further than 10 years. And unfortunately, this doesn't do it. But I'd like to see when we had a year on year, when the overall GDP, or even quarter by quarter going back, to like 1980 was at 4.6. There's not going to be too many times. That for a developed economy, a 4.6 real GDP number is incredible. That's incredibly good. So then you have to ask the question, when you consider all of the volatility we've had, when you consider your own anecdotal experience in your life, talking to coworkers, talking to family members, does this seem like one of the best economies we have ever had in the last, call it 40 years? So I'm not saying that you're going into an economic depression or anything, but really, like it seems that's a hard pill for me to swallow. Now, maybe it happens. And what would be the catalyst there? Now think about it from this angle. You guys know that the poor and middle class has been really, really struggling because their purchasing power has been going down significantly. You guys know why? Because the prices of stuff has gone up more than their nominal wages. Now you add to that people have to start paying their student loans. You see the credit card delinquencies skyrocketing. You see the auto loan delinquencies skyrocketing. You see the mortgage rate delinquencies creeping up. You see the explosion of buy now, pay later. And you look around and you're like, is that really a reflection of a booming economy? Not to mention what's happening with interest rates. Now, let me add another data point in there for you. We go back to the calendar and we see, where was it here? Factory orders. Factory orders expectations were for a negative 3.3%, which is terrible. It's atrocious. I mean, last month it was 3.4. And the actual number came in at negative 3.7%, a negative 3.7%. Now you've got the job openings. So this is good. The expectation was for 7.1. We had 7.4. So that's really good. But with factory orders at a negative 3.7, do we really think that the inventory levels are going to rise? I mean, that doesn't make a lot of sense to me. Now, let's go over to some of the details here because this is really interesting. Let me go ahead and click on this. And we're going to go to the last full report. So last month, and this is front running, all of these economic distortions that have been created by the tariffs. And you can like them, you can hate them, whatever. The bottom line is they created a lot of uncertainty and a lot of economic distortions, regardless of what their long-term impacts will be. So we had a positive 3.4%. Front running. That makes sense. You'd probably do the exact same thing if you owned a business. And prior to that, it wasn't great. You know, you got a positive 0.4, positive 0.3, positive 0.5. But then we go to this blowout number, 3.4, and then we go to a complete crash of 3.7. And you'll notice the net here would be a negative 0.3. So again, we're looking at a negative 0.3 here on new orders. And you're telling me that GDP is going to be 4.6 in real terms? I'm not saying it isn't going to be, but I'm saying I think the probability is pretty low. Who knows? Maybe I'm crazy. But I'd love for you guys to tell me, and especially considering this would be such an outlier going back not just 10 years, but my guess is if we went back the last 25 years, that a 4.6 number would be an outlier, even going back multiple decades. So I'd ask everyone in the chat right now, see if we switch up the screen share. I mean, does it feel to you, or when you talk to your friends and family members, are they telling you that this is the best economy that they've ever seen in the last 25 years or close to the very best? Are they saying that their purchasing power is exploding and they're just so rich and they're making so much money that they don't even know what to do with it? Or are they telling you, you know, the job market's softening, I don't want to quit my job, and I'm having to get another part-time job because I just can't make ends meet? Like, which one is it? And I would be willing to bet that the majority of the people on the live stream or watching this video right now would say that it's the latter. That yes, we're able to, you know, get food on the table and a roof over our head, but it's getting tougher and tougher and tougher to do that. And that's not what you see in an economy where real GDP is growing at 4.6%, especially in the developed world. So we'll have to see how this plays out. I'm very fascinated. And it's really interesting to see this. You know, it's always interesting to see a dramatic decrease or a dramatic increase in this number and just try to think through why. And this helps us understand the macroeconomic environment, I think, even better. And it also makes us realize when you're looking at these data points, they're never all bullish and they're never all bearish. So what you have to do is you have to look at everything, the totality of information you have, And then it's just a matter of a scale. You're just weighing the good versus the bad. Where what most people do, I think, is they just exclusively focus on the bad, or they exclusively focus on the good. And for me, if I have a bearish view, it's not because I don't think there's anything bullish or there's not a bullish argument. It's just when I'm using my weighing machine, it seems like the negative data, or the data softening, is kind of tipping the scales, right? And then when you take that and you use that information to come up with an investment strategy, that's why for me, I prefer to be a little bit more risk off. All right, guys, enjoy the rest of your afternoon. As always, make sure you are standing up for freedom, liberty, free market, capitalism. We'll see you in the next video.